Hi, I'm Darcy from the NZ Everyday Investor. Central banks around the world are churning out new currency at phenomenal levels right now. We call this quantitative easing, or QE for short. The idea here is to fill up the gigantic potholes left in our economies after a rather unpleasant first half of 2020. With all this money printing going on, does this really lead to an increase in value being circulated? Or are central banks merely diluting the value that already exists out there? What appears to be working now may actually have some serious side effects later on. Specifically, as investors, we're justifiably concerned about this thing called inflation. If the price of our investments goes up, that may on the surface look really good, but what if the currency that denominates these investments have been watered down? Has our net worth really increased? In this episode, we're asking the question about inflation. Is it a friend or is it a foe? Chris Tennent-Brown is the senior wealth economist at ASB Bank, and he's my special guest today. At the end of this episode, you'll understand what inflation is, why central banks try to control it, and most importantly, what should we as everyday investors be doing to hedge against it? Be sure to subscribe and give us a thumbs up if you like these videos. Let's get started. So welcome to the NZ Everyday Investor. I'm your host, Darcy Ungaro, and I'm in the studio today with Chris Tennent-Brown. Chris, welcome.
Thank you.
Thanks for joining us. Now, Chris, you are, I was just saying before, you're the triple threat. You are you're the senior wealth economist at ASB.
That's it.
You are a pilot who, you're on your way to becoming potentially a commercial pilot at some stage, and you're a podcaster.
That's it.
Yeah. What do you fly? So when you go flying, you fly out of Ardmore, out of Auckland here.
That's it.
So what kind of plane do you fly?
So I learned to fly in a Cessna, the Mazda 323 of the Sky 172.
Yeah.
But I've got a small share in a Chipmunk, which is a de Havilland aircraft from the 50s that was used as a basic trainer in the Air Force.
Awesome. So today we're going to have a broad discussion trying to answer this question. Hey, what is inflation and why should we even care? The answer is, hey, we should care, but it was really important, I think, for us to define it first. So I've got the definition here of what is inflation straight from the Reserve Bank of New Zealand, and I'll quickly read it out, and then we can discuss a little bit.
Yeah.
So inflation is the term used to describe a rise of average prices through the economy. It means that money is losing its value. The underlying cause is usually that too much money is available to purchase too few goods and services, or that demand in the economy is outpacing supply. In general, this situation occurs when an economy is so buoyant that there are widespread shortages of labor and materials. Chris, what do you think? So that's obviously the lengthy version of it, but in a nutshell, if you were to say this is what inflation is, what would be an abridged version of that?
Yeah, well, that's a pretty good definition. I just think inflation for most people means how much more is something going to cost me in the future than it does today.
Yes.
Or how much is something costing me now compared to what I could have bought it for a few years ago.
Got it.
And so
it's kind of a relative thing, isn't it? It's like you're in a little rowboat and you're trying to jump onto the jetty, and as you push away, you realize that you're actually in the same place. It's this relative thing going on, isn't it?
Yeah, and I think for investors, it's just one of the many uncertainties that go into the mix when you're trying to work out, hey, how much is my consumption in the future, my retirement, going to cost? And so how much consumption do I need to put aside today?
That's right.
Or in simple terms, how much do I need to save to pay for all the stuff I'm going to need in the future?
Correct.
So knowing what price things are going to be in the future is the important bit.
Correct.
And this is where inflation comes in. And the other thing where it comes in is when people are making their way through life and they're trying to save and they feel like the cost of living keeps on going up against them. Well, that's impacting their money left over in their pocket at the end of the week. So inflation comes into that mix as well.
So there's a couple of things going on here. There's, hey, how much do we need to live off of when we retire? And we need to bring a calculation to bring that back into today to figure out how much we need to be setting aside, making an assumption on what the inflation rate will be. But we also need to understand what the cost of things will actually be in the future when we get there, because that will impact things, because it might not be a homogenous piece. And then we need to think about, well, on the way there, what will stop us from saving really well? Well, if the cost of living increases beyond our ability to earn, then that's a factor as well. So it's multidimensional, isn't it?
Yeah, and it all goes into the mix. So that someone like a central banker or an economist, we tend to think about the consumer price index.
Yeah.
And at the moment, that's saying that inflation's running at 2.5%.
Yeah.
It's averaged closer to 1% over the last few years. But you won't find many people agreeing with you that inflation's contained, because they blended in with the cost of living, which is a slightly different thing. But
okay, talk to me about that. Like when we talk about the CPI or the basket of goods.
Yeah.
Talk to me about what's actually in there and how they kind of measure it.
Yeah. Well, the consumer price index, or CPI as we call it, is the measure that we use for inflation. So Statistics New Zealand prices up that basket of goods, and we look at the rate that basket changes from period to period. In New Zealand's case, it's quarterly that it's measured, but we tend to talk about annual inflation. When I said 2.5%, that's how much that basket of goods within the consumer price index went up compared to a year ago.
Yeah.
And so it's a funny old thing to look at. It's got everything like how much it costs to get your cat spayed. It's got some allocation for costs of medicine. It's got groceries, the things which consumers would buy. And a lot of that stuff's pretty easy to understand. I mean, we could all go into a supermarket and see what is a kilo of cheese cost now, and what did it. Well, we could look at a receipt and see what it cost a year ago. That stuff's easy.
Yeah.
Likewise, we can all say how much did it cost to fill up my car this year compared to last year. But there's a whole lot of other stuff that we do that's really hard to calculate. Like, for example, how do you compare what you pay for a telephone
correct.
now compared to 15 years ago? I've had a cell phone for a while, but what I use it for has changed massively.
So let's talk about that, because cheese is cheese, right?
Yeah.
Last time I checked, it's cheese. And there's no technological advancements that make the production of cheese incredibly different.
And we still do the same thing with it, right?
Yeah.
Make mousetraps and
that's right,
and that sort of thing.
Yeah. So what we use it for, you're right. Yeah, what we use it for and how it's made is the same. So technology hasn't necessarily changed. I guess the effort and the value that's consumed to produce that product.
Yeah.
But when we look at a phone, like your iPhone, for example, it's completely different.
Oh yeah. I mean, you think of a setup 15 years ago. Most houses would have a landline and a cell phone, and we're starting to get into things like texting and that sort of stuff.
Yeah.
And clearly getting into things like the internet. Although 15 years ago, not everyone had access to the internet.
That's right.
But now your cell phone is everything, right?
Yep.
It's not only is it. I don't even have a landline anymore, so it's replaced that. I don't need to have broadband at home. I could do everything over my cell phone if I wanted to. I can access the internet. I can use all these different messenger services, etc.
Yeah.
But it's also my bargaining tool when I'm trying to work out what to pay for things. Who just walks into a car yard or into a travel agent's and says, just make me a price. Tell me what it's going to cost to buy this car or buy this trip.
Correct.
We can use our cell phones to aggregate and sort out what prices we want to pay. So it's an incredibly powerful thing in our lives, but it's also incredibly different compared to 10 years ago. It's different compared to 2 years ago.
Yeah.
So for poor old Statistics New Zealand, they try and make a quality adjustment to things like the cost of data, the cost of a cell phone, but it's incredibly different because they change it. Now, the other thing which tends to happen with inflation is not only is that stuff hard to capture, but for us as individuals, we tend to form our judgment about cost of living and inflation based on things we do all the time. So when petrol prices go up a lot, people think, wow, inflation's really high. We read a lot about things like the rates. We have to pay them each quarter. So, those things are things which feed into our thoughts about inflation. The stuff that's getting cheaper and cheaper, a lot of it's imported from overseas, cars, flat screen TVs, cell phones.
Yeah.
But we tend to buy those things every few years. And we tend to make our judgments about those items based on what we want to get. So I thought, what features do I really need in a phone, and I'm going to buy it. And then I might think, I'll buy the slightly cheaper model. But I'm not thinking, hey, this cell phone's really cheap. I'm thinking it's really expensive because it's gone up from the last time I made that purchase a few years ago.
Gotcha.
So our inflation judgments are...
It's very relative, isn't it?
Yeah, really, really relative.
Yeah.
And the other thing which goes into the mix, and this is important when we're talking about retirement, is it's different for different people. You know, if you're working, raising kids, you tend to think of a lot of costs like school fees, public transport, the cost of clothing and uniforms, the cost of suits to go to work. Food will be in there a bit, travel will be there in a bit. When you get old and retired, your basket changes. Medical and healthcare will be a more important issue, and you'll probably spend more money on it. You probably make that last suit you bought last an awful lot longer than if you're wearing one 5 days a week going to work.
This is why Granny's got such an old couch. Yeah, and there's plastic all over it.
Yeah,
this is why. Now I know the answer. Yeah,
yeah, and so everyone's basket of goods that they're making their inflation judgment on differs.
Right.
And so this is, one bit of advice I give to anyone is don't get in an argument about whether inflation's 2% or not. Yeah. Think about what your cost of living is, how to manage your budget, and what your cost of living is likely to be in the future, and then make a plan for it. You just got to accept, hey, the CPI's consumer price index has got some quirks, but that is ultimately what the Reserve Bank's got to focus on, and they're trying to keep that inflation around 2%, which is the
Goldilocks zone.
Yeah, the Goldilocks zone. There's nothing magical about that. I mean, I learned the theories at university that the only rate of inflation you should target is 0. Yeah. But we've learned that usually you're sacrificing a bit of economic growth and employment if you want to keep inflation that low.
So we'll come back to that, but I want to, I guess, answer a question that I've often had, and I've had answers that I kind of accept and understand to varying degrees along the way every time I ask this question. But why isn't interest cost included in this basket of goods, which determines CPI or the consumer price index? Why isn't interest cost?
That's a really good question. Essentially, if you put interest costs in there, you'd get a circular situation right now.
Right, because like feedback.
The Reserve Bank ultimately uses interest rates to control or to influence the amount of demand that's within an economy. So when there's, back to your earlier definition, when there's too much demand in the economy, they can raise interest rates to try and cool things down. But then if that was included in the inflation that they were trying to target, fighting inflation, they'll be causing inflation. You accept that it's part of a cost of living, for sure, but it's part of your tool to fight inflation. You don't want it to be incorporated in the number itself.
Yeah.
Now, the main source of interest cost for people relates to their mortgage, right? And so within the consumer price index, there is a component of that for the consumption of a house, if you like. So an implied rent component, which of course does go up and down with movements in the housing market, and it is influenced by things like interest rates, but not in terms of a feedback.
Not directly. So indirectly, it is kind of captured, but not directly.
Yeah.
Okay. Yeah. And I understand why. So thanks for making that clear, because that's something. But it's interesting. Like it's still real.
Yeah.
Like I was running the numbers on our own home, and I think I worked out that 5 years ago when we bought it compared to today, we could potentially, with the interest rate drops that we've seen, we could potentially borrow another $800,000.
Yeah.
And it would cost the exact same amount.
Yeah.
For one of the biggest components in our monthly bills, that's gone down considerably. Like it's massive.
Yeah. Yeah. It's an interesting one. And again, coming back to the earlier points, this is why it's important to think about this is just part of the mix for thinking about a budget. There's all sorts of complexities that go on with it. And so for most people, they're thinking about the cost of living aspect of it. Yeah. So lower interest rates or higher interest rates, people get that sort of feeding into their thoughts about inflation, but that's more of a cost of living and a budgeting thing.
Right, gotcha.
But ultimately, that's the thing which we need to be thinking about as investment professionals and as people saving towards retirement is budgeting and cost of living. Yeah. Inflation's just part of that. Part of that mix.
Cool. Okay. Going back to this definition from the Reserve Bank here, which I'm sure is not exclusively from the Reserve Bank. This is just what it is. Inflation means that money is losing its value. And so let's just dive into this a little bit. So thinking about our currency that we're using as containers of value or vessels of something that's got something of worth in it. I guess the way to visualize inflation is that over time, the ability of that vessel to contain value gets eroded.
Yeah.
It's unable to do that. And I'm thinking about specifically now what happens when you dilute the currency, when you create more currency. Let's assume value is a constant, but you're dividing up the units into even more smaller parcels. Is that effectively a way of describing what's happening when the Reserve Bank is engaging in QE or quantitative easing?
Yeah, I mean, this is at the heart of what people worry about when they think the Reserve Bank's effectively creating more money and buying government bonds, is it's going to be inflationary.
Yeah.
Now, if you had inflation running strong in an economy, you'd never be doing QE, or quantitative easing. You're doing it because you've got the opposite problem. You're worried about the examples people think of as the hyperinflation in Germany last century, some of the basket case economies around the world.
Yeah.
Now, if you had collapsing productivity within an economy, so it was making less and less because the economy itself wasn't working, and you thought you were going to stimulate it by making more and more money, all you're going to do is put prices up, right?
Correct.
You know, if the classic economics example is you've got an economy, it's got 10 people in it, it's got 10 bananas and $10, and everyone gets given $1. They've still only got 10 bananas. Give them $2 each per person. Well, you've still only got 10 bananas to buy, so the cost of a banana is going to double to $2.
Right.
Now, quantitative easing, that's what people worry about. If all this money is just going to get dumped into an economy, are we going to see massive inflation? And you won't, as long as you've got a slow velocity of money, if you've got an economy that's underperforming like ours is now.
Yeah.
Sure, if the economy was going gangbusters, you'd generate a lot of inflation pressure out of it, but you'd be doing different things. That would be, if that was the case, you'd be raising interest rates. We're lowering interest rates and putting more money into the economy to support it and stimulate it.
Yeah.
So the question is when an economy gets back to on its own 2 feet, like we saw, say, in the US economy a couple of years ago, you've got to wean off these policies, and that's what the Fed was doing in the States. They were raising interest rates. They were letting their bonds that they held roll off their books. So in other words, they were taking money out of circulation of the economy. And then along came COVID-19, and here we are. They're printing money again. We're doing it here in New Zealand.
Yeah.
So,
but what I'm hearing though is that as long as the preconditions are appropriate, engaging in quantitative easing won't necessarily create inflation, because there's actually, it's kind of like filling in a pothole.
Exactly.
You're bogging up the wall with builder's bog.
The whole idea is that you get the economy functioning at a stronger level, and it starts to generate that Goldilocks number, if you like, around 2% inflation, and then you can return to more conventional policy. And all of that stuff is a long way down the road by the track.
Yeah.
By the way, we're going to be doing this crazy stuff for a year or two, I'd say.
Yeah, and the natural thinking, and I think it is totally appropriate to think about this, is like, well, what happens then? Like, when do we wean off this, and are there going to be any side effects, withdrawal effects from coming off this opioid currency injection here? Like, is it going to get messy? But like, how could this potentially play out when it's time to taper off? What is it going to look like?
Well, the thing that everyone always needs to have in the back of their mind when you've got ultra low interest rates is that makes debt cheap. So to your example, you could keep your mortgage payments the same, but borrow more and have a better house, or do that renovation now while the interest rates are low. Yeah. But sooner or later, the problem comes if interest rates go up.
Correct.
That's the problem for the government. Their debt's increasing. That's the problem for households if their debt increases. So sooner or later, you've got to pay this thing back. Or if your strategy isn't to pay it back, you might have to pay a higher interest servicing cost. Yeah. So the tricky thing in a bank is to go, okay, well, what's that number? We're forecasting mortgages to stay between 3% and 5% for several years. but is it prudent for us to come in and say, hey, look, we'll do your calcs based on 3%. That's what we can lend your money at. Or should we factor in, say, the average mortgage over the previous 20 years? I mean, most people have a mortgage for about 20 years of their lives. So if we took that number, it'd be more like 7%. If we went back to the 80s, we'd be saying, hey, you need to budget for 20%. But here we are. You can borrow money for under 3% right now. So again, this comes back to, okay, what are some prudent numbers to budget on? And inflation's part of that. If we don't have a lot of inflation in the economy, you typically expect to see very low interest rates for a while.
Yeah.
And the Reserve Bank's forecasting that rates stay low for several years. Yeah. Inflation stays contained for several years. And their problem is not enough inflation rather than it getting out of hand.
Yeah.
If that situation changed, they'd change their mind. And ultimately that's the situation we could have been in if it wasn't for COVID-19.
True. Yeah, we were kind of probably almost tracking towards that, right? We were kind of waiting for the bottom.
Okay, hey, the next move will be up. I mean, I wrote a home loan article which basically discussed that the lowest rates could be behind us. And I put it out late last year.
Amazing.
Hey, how wrong was that? But if you told me, hey, we're about to have a global pandemic, I wouldn't have put that note out.
That's right.
But at the time, I thought, well, the economy is going to be going pretty well with these 3.5% mortgages that are pumping through it. That seemed low.
And I guess like the other part of this is that as interest rates stay low for longer and people get, you're getting hooked on this, right? And that's fine as long as it keeps on coming. And but when they start increasing the pain level, when they start increasing the cost of the money, which you now or the debt, which you now hold a lot more of, they actually don't need to increase it by much to get a big, massive aggregate impact.
And that's one of the reasons why we don't think interest rates will go back to anywhere near the levels we've seen in the past 10, 20 years.
That's right. And that's hard for some people to get because they're thinking late 80s, 22%. But really, the new 22% could actually be 4.5%.
Oh, absolutely. If interest rates got put up by 1% or 2% from today's level, it would slow the economy an awful lot. All of this low interest rates and low inflation sounds like good news if you're in debt. But for a saver, it's tough because now you're looking at term deposit rates that are largely below 2%. And inflation's low, but it's still there.
Yeah.
So if you're getting, say, 1.8% on a term deposit, even if inflation is what we think it'll be, somewhere between 1% and 2%, by the time you take into tax, you're going nowhere.
Yeah.
Your money's not growing in real terms, and that's a term that you'll hear economists talking about. Inflation adjusted terms.
So that's just the rate of return minus inflation.
Yeah.
Real return.
Yeah. So the real returns are going to be incredibly low in this environment, which means that saving in a low inflation and low interest rate environment is really tricky.
I know.
Now, 10 years ago, term deposits were much higher.
Yeah.
Now there were times when those returns got eroded by inflation. Remember, one year we paid a 5.25% term deposit. Now everyone would just dance with joy for that sort of rate now. Yeah. But in that year, it actually completely got eroded by inflation because we had an unexpected increase in GST. So inflation was over 5% for that particular year. So you went nowhere in a high interest rate environment as well if inflation was eroding the return. So that's why economists keep coming back to this idea of, are real returns positive? And they're slightly positive at the moment, but barely. Yeah. So that makes it tough for savers.
It does, and this is why we covered that. I guess last week we covered this, the hunt for yield. That's why people you can't stay still. You can't just have a bunch of money in your savings account or in a term deposit because inflation will rob you blind. You have to move forward. But if you do move forward, if you move up the risk spectrum and you're getting into term deposits or bonds or property shares, you're moving up that risk spectrum, you need to understand what the risks are. You need to have a plan.
Yeah.
You need to actually think about this. Yeah. But a lot of people don't.
Yeah. And this is where I always come back to, rather than getting too hooked up on what inflation is get some general thinking around it. But essentially, it's just a number you're putting into some long-term projections. You're not going to solve this low-term deposit in a quick fix.
Correct.
It's more important now than it has been in the past to a lot of people that they need to do something more complex than term deposits. Now that's uncomfortable for some people because we had a long period of time where term deposits would get people there, and yet here we are where you can't even get a quarter of what you could 20 years ago. So people are understandably frustrated by this, and even now there's people rolling off 5-year term deposits that are coming out of environment where they would have been getting 4%, 5%, and now they're going, what do you mean the highest you've got is 1.8%? And so if you say, hey, it's a low interest, low inflation environment, they're going to have this feeling, well, there's still inflation there, and I'm not going to get anywhere with this money. But that doesn't mean they should just go out and power into equity. So that's why I keep coming back to this idea of it's about budgeting. Inflation's just part of it, but you've got to plan pretty seriously and very long term now when you're thinking about these things, because it is tougher to get a real return.
Correct.
Even though inflation's not there eating it all up, it's still there.
I know,
nibbling away. And so these low interest rates are tricky to manage.
And like I just keep going back in my mind anyway. I'm just going back to this that image that you gave me at the start. We're talking about the bananas, right? Like ultimately, there's still just 10 bananas. We can say that it's $1 each or $2 each, depending on how much currency you've put in the system to trade these bananas with each other. But really, often we make it a little bit too complex for our own good, right?
Yeah, and the common question that people have, they're not going to build their own inflation forecaster. They just want to know, what percentage of my income do you think is good to be putting aside, and what number do you think I need to have in my bank account when I retire to be comfortable? And that all varies from person to person, of course. But those are the useful numbers that people can comprehend.
Yeah, and I guess the next thing I'm thinking of is that, like, let's say you've done that, you've gone through that, you figure out what that number is, you're putting it aside. Still, you need to account for the unexpected. So if you had a 30-year bond, right, you're not really factoring in changes along the way. You've kind of set and forget. But talking about some of the hedges against inflation, I guess investing in equities is kind of a bit of a hedge, right? So like if we just, I guess, theorize that maybe there is inflation right now. Let's pretend there is inflation. Let's say, for argument's sake, with all the quantitative easing that's happening in the US and around the world, that's pumping up equity markets. Effectively, if you put your money in there and everything's growing in value, then it's a hedge, right? You're going along with it. Is there some logic in that?
Yeah, being diversified and in the appropriate mix of assets will be the main hedge.
Yeah.
And in New Zealand's case, those really high returning term deposits were a distraction from people getting to where they should have been.
Yeah.
So a portfolio of diversified shares and other assets, which should include these bonds and cash, which has such terrible returns now, is the way to go forward. And funnily, we still get people saying, "Why are these bonds in the portfolio?"
These funny little critters.
They don't provide great returns, but boy, they were quite a nice buffer in a portfolio in March when share markets were dropping.
That's right. Yeah.
So the relativity of asset classes doesn't really change, but the right mix might change. And the term deposit example is the best one. For a lot of people, term deposits were the right thing 10 years ago. If you could have kept that return going forever, but because you can't, and you certainly can't today, then these other assets come in. But at the heart of it, for any investor that's talking to an advisor, inflation will be part of the budgeting mix that they're doing. And in ASB's case, our KiwiSaver Explorer tool makes assumptions. Being a bit of a geek, I like getting inside that tool and seeing what they are. And we use for inflation, that 2% number. Ultimately, that's what the Reserve Bank's targeting, and that's what we believe they'll achieve over the next 10, 20 years.
I guess that's a reasonable thing to do, right? Like if the Reserve Bank's doing a pretty good job, like they're pretty actively doing stuff.
Absolutely.
So you could put a little bit of faith in that, say, 2% figure that you're using for your modeling, because you know that the Reserve Bank is going to do whatever the hell it takes to make that happen. right? So it's kind of a reasonable thing to do.
Oh, and economists on the whole will be making their thinking about around where inflation's going to be, around that assumption that the Reserve Bank will do their job.
As long as we have faith in that, that's good.
We might think at times like now that they'll undershoot.
Yeah.
So inflation expectations are a little bit low for the Reserve Bank's liking at the moment, and that reflects the current environment.
Yeah.
In Australia, they've got a 2.5% target effectively because they've got a 2 to 3% inflation target range. We have to make decisions about, do we think the Reserve Bank's got the ability to do its job and meet its inflation target, which is, to your point, I think they are doing a good job at the moment. Yeah. And when the situation changes, the Reserve Bank will change. And it was only back in February that the Reserve Bank was comfortably on hold with the cash rate at 1%.
That's right.
No one in their wildest dreams was thinking, the Reserve Bank will be doing quantitative easing within a month.
Well, I know. Like when I spoke with you last time on the podcast, I think that was actually just happening as we were speaking. They must have been listening to us.
Exactly.
They were just taking the cues from us. But I remember saying to you at the time that, it took Reserve Banks, it took the US Fed, I guess, a long time to actually kick into gear following the GFC, the global financial crisis.
Whereas this time around, it's all of the first 2 or 3 weeks as far as the pandemic touching our economies. And so, quite different. And
they were ready.
Yeah. And, back to inflation, you wouldn't be doing this stuff if you had an inflation problem in the economy. You're doing it because you've got a lack of inflation problem coming because of the hit that COVID-19's.
So talk me through that then, because it seems like it is appropriate to have this policy of quantitative easing and low interest rates at the same time because of the environment that we're in.
Yeah,
it seems like the risk of inflation is still very low.
Yeah,
and you can observe that, but is there a possibility that at some stage things could change quite quickly, or is this going to be a slow moving thing with inflation? Like, I'm just conscious of the fact that it's such a dynamic environment right now.
Yeah,
with stuff happening in the New Zealand economy that we haven't tried before necessarily.
Yeah,
could that quickly catch on something and cause hyperinflation? No,
I don't think so. The situation will change. It always does. And there's a number of scenarios at the start of this, but basically think of a best case and a worst case and a core scenario. We're going towards the best case scenario in terms of the ability to recover. The Reserve Bank is constantly monitoring what's going on and trying to map the outlook for the economy. It's not like this is suddenly going to disappear and we think, game on, it's all fine. That situation will evolve over a period of months, quarter, I think years, and then the Reserve Bank will slowly respond, and that's always the case. I mean, when we look at how we thought the Fed in the States would behave last year, the Reserve Bank in New Zealand would behave. They didn't do exactly what we thought, but ultimately their decisions were there or thereabouts. No one thought, wow, they're making massive policy errors here, and I don't think that now. If the economy really started to go nuts and we thought, hey, suddenly the virus disappeared, that's sort of what happened with SARS, and it was much, much better than anyone imagined. Well, then you'd probably see them changing their forecasts quite a bit and changing the way that they behave over the next 2 or 3 years.
Okay.
But that's not going to happen over the next 2 or 3 months.
No.
This is going to take a long time to turn around.
Yeah.
So I don't see there's any risk that this suddenly turns into a completely different inflation environment to what they.
And do you see any other side effects that could potentially happen? Like it's just new territory. I'm just trying to figure out.
Yeah, well, I think what you can see at times like this, where assets are expensive, right? Share markets, when you can only get 1% on a term deposit, then people are prepared to pay more for a share that's generating a 5% dividend yield, for example. So assets get expensive in a low interest rate environment. People will pay more for a house if their debt servicing costs are lower. So you are sensitive to news. As we saw in March when the landscape changed, equity markets took a pretty major plunge.
Correct.
I mean,
That's right.
30% decline in the space of a month, massive.
Yeah.
But so's a 30% recovery over the next 2 months.
And that's
so
yeah,
things can
yeah, right.
move pretty fast. So
yeah,
I get back to the earlier point: is people really need to focus on their own goals and quite long-term goals,
correct.
because you can't predict that volatility in markets, but it
No.
can be volatile when the story's changing as much as it can
Yeah.
right now.
Yeah.
Imagine how much it's going to change the global investment landscape if we get, say, a big second wave in China. That's a risk. If we get another round of trade tensions
Yeah.
going on between US and China. So
Correct.
there's lots of things that could cause volatility right now, and we're a little bit edgy.
That's
And
your itchy trigger finger. Yeah.
yeah, but ultimately that's a good thing. You do want markets, you don't want it to be a one-way street. You don't want it to be low volatility, because that tends to make people a bit complacent.
Yeah.
You want investors to be
Yeah.
thinking about these.
And I
these
guess like
risks.
the financial markets have acted as a bit of an absorbent for the QE, right? Like all this extra currency being injected, it hasn't necessarily been inflationary, perhaps, because it hasn't landed in our back pockets. It's landed in financial markets, right?
It'd be inflationary if the economy was running at full capacity and had heaps of demand, and suddenly you just chucked a whole lot more money into it. We're doing the opposite. The economy's got a big pothole.
Yeah.
So the government's trying to help it through that pothole.
Yeah.
And the Reserve Bank itself is with its monetary policy is trying to support that. But don't forget that QE is playing a minor role in this whole thing compared to the government that's playing the major role around the world. The biggest thing that's going on that's driving economies and that in turn is helping share markets go well is a belief that governments are doing the right thing by turning the taps on and spending to make up for the massive income shock that's taken place around the world. That's the main thing that's going on at the moment. And none of this would need to be happening if we didn't have this income shock. And to get back right to the start, to the definition of inflation, inflation tends to happen when an economy is really buoyant and there's too much demand in the economy. So we've got the opposite problem right now.
Yeah.
Hence all this stuff that's going on.
It's not simple either. Like it's simple when you think about bananas.
Yeah.
But it's not simple when you think about all the other stuff.
Exactly.
Take me back to the bananas.
Yeah. and none of it's quite like the textbooks at university, which tries to make a mathematical model out of it. But there's many moving parts. But for most people, I think the basics of understanding it is thinking about how it impacts them and their budgets.
Correct.
And then hopefully if you've got the right tools getting put in front of you, there's been some pretty reasonable assumptions getting put into it, inflation being one of them. I think the thing which creates the biggest uncertainty for most people in their retirement is how long you're going to live and how bad's the medical bill going to be.
That's right.
And
that's right.
And those are really big.
And that's probably one of the key things that I think that you've just highlighted for me anyway, is that I guess for different ages and stages that you're at, like we're at right now, flat screen TV, the latest phone, trips to Fiji with the family. Those are things that I'm sensitive to now, if I wanted to do those or could do those things. Whereas when I am 70 years old, for example, the biggest thing is going to be my medical insurance. And I know what's going to happen there, and it's not going to be pretty.
Yeah.
And then I guess there's other things like rates. I understand why people can get upset about that.
Yeah.
That totally makes sense. But they might not be worried about trips away, and they might not worry about school fees and the price of fuel because you're not going so many places, right? So it's not a homogenous thing. When you think about inflation, it's actually, there's a lot of different subcomponents of that you could strip out depending on the age and stage that you're at.
Yeah.
Like medical inflation is what they refer to it in the insurance game. Medical inflation, the rising cost of not just the premiums because of, say, demographic bulges pushing it up because of claims exposure, but also the rising cost of medical treatment because of medical advancements.
Yeah.
It seems to be a good opposite sort of thing to put side by side with that cell phone example that we started with at the beginning, where technology can sometimes be very deflationary.
Yeah.
Yet in this other sector with health, we've got this incredible inflationary thing going on.
And we we can't do everything, but when it comes to your own individual medical care, we like the idea that we can.
Yeah.
But think of whether you've got a private system like the States or a public system like here. Ultimately, there's a cost for all of these things.
Yeah.
And it's an important part of the whole mix for how people want to see out their older days.
That's right.
And, it's really hard to factor in, and the inflation dynamics of it. It's certainly there's no connection with it to something that the Reserve Bank's targeting, like consumer price index. But that's not their job, right? The Reserve, from my observations over the past 20 or 30 years, you've got to keep it pretty simple for central banks. I mean, even now where we've got an employment and an inflation target for our Reserve Bank, like the Australian Reserve Bank and the Fed does. It's quite common. But even those two goals can get conflicting. When you might be wanting to do one thing for employment and another thing for inflation.
Right.
If
I'm thinking of the Phillips curve.
If we had a lot of inflation in the economy, but the unemployment rate was 6%, but for some reason we had a lot of inflation, well, you'd be wanting to cut interest rates to stimulate the economy to get the unemployment rate lower, but that would be generating inflation. So if you started to go, hey, we've got to have multiple consumer price indexes, you've got to factor in medical care and all that sort of stuff. You quickly get to the point where the Reserve Bank would go,
I give up. That's just too much.
That's actually, you're talking about fiscal policy here. Monetary policy can only do so much.
Right.
And so price stability and financial stability are what the Reserve Banks focus on, and this is where that consumer price index comes in.
Got it.
All of these other things are more on the realm of, well, what should the government do with their resources, and what can I do, and what's realistic for me to budget with? And this is where a good financial plan is just
right. And that's why I guess we keep coming back to that, because it is actually really important. I think for so many years, maybe because inflation has been so well controlled for a while, we've probably gotten a little bit complacent around this.
Well, it hasn't seemed like a problem, but it clearly is when it's not running at 2.5% if you're retired, that's for sure. And particularly if you've got to make health choices. And this is why within the sector, there's often been a reasonable relationship between an accountant, a financial planner, and the insurance sector, because they're all part of the mix of trying to solve this financial riddle.
And it is a riddle, and it does need to be solved. And I think, if anything, why are we talking about inflation? Well, because it's actually really important if you're trying to build wealth. Really, really important. And you got to actually take ownership of the fact that if you don't try to get a plan together to solve inflation, it's probably not going to be solved for you. You'll be a victim to it. So you actually need to invest, and you need to do so thoughtfully. Get some advice around how to construct a portfolio which is diversified so that you can ride out the storm, right? Like it's not something that someone else is going to solve for you. The Reserve Bank will create the environment, hopefully, and they'll stay within that range. But it's up to you now. What are you going to do to actually stake your claim in the future, right?
Absolutely. And this is where I think that concept of, do you believe the Reserve Bank's going to be able to do their job's important? And for me, I think, I do. I think, okay, if the Reserve Bank does their job, it's safe for me to assume that 2% number for inflation is a good one to calculate on. I said I can have a 20-second conversation about this, or a 20-minute one, and I come back to the same place, get a good plan, get diversified, stick with a strategy. And inflation's part of the mix on that one.
Good stuff. Stagflation, before we finish up.
Tricky thing with the standard framework for central banks is that we've got this idea of, when the inflation's running really hot, you can raise interest rates, curb demand a little bit, and curb the inflation pressures within the economy. So, but it's all about moderating inflation by moderating growth, with interest rates being the variable that you use to change the demand within the economy. So that doesn't work if you've got inflation but no demand. Stagflation and deflation are probably the two uglies from the Reserve Bank's perspective, because it's hard to know what to do. Deflation, you just don't want to go there, as we've seen in Japan's case. If you know that something's going to be a few percent cheaper in the future, it tends to make you defer consumption, which drops demand.
Spirals out of control.
And that can happen. Stagflation, you've got twin evils. Do you tolerate the inflation to get growth a bit better and get your unemployment rate down, or do you tolerate the lower growth and the high unemployment rate to hope that you purge the inflation out? It's hard to manage. I don't think we need to worry about either of those at the moment. To me, the big worry is getting the right mix of government expenditure to get us through this downturn. And
good old Keynesian economics will get us through.
Yeah, well, you can chuck money at the problem, but it needs to be well spent, or otherwise we won't get the productivity gains that we want. It'll just be a band-aid to get us through. And we're in the band-aid stage at the moment. When we're all locked down, that's what stage you're in. But now we need to work out what does the new world look like, and where's the right place for the government to spend money. How do we open up the bits of the economy to trade again? And then what does the mix look like that? And again, with inflation, global trade's been a key part of that for us. We've tended to import a lot of stuff which has been deflationary, the flat screen TVs and all that sort of stuff. And we've exported stuff that we've actually got pretty good prices for. The value of our exports is pretty good at the moment. All of these dynamics that are going on with the economy now are important for our recovery, but they're also important for our income outlook and our inflation outlook. So those are the developments that I think are worth focusing on, rather than the central bank itself. The central bank thing that I think is interesting is what do they do next? What if growth and inflation trends down towards zero? Do they?
Correct.
They can only cut interest rates so far.
Correct.
As we've seen in Japan, they can actually buy an awful lot more government bonds. They can get into even other assets. So hopefully we never get there, but I hope we'd never get to quantitative easing either. You look at other central banks, it's essentially open-ended. We'll keep buying government bonds until growth returns to normal. It's not that those aren't unreasonable things for those central banks to do. I just hope our economy doesn't get that bad.
Right, because it means that something has become a lot worse to warrant that.
And I said the same when interest rates were 4%. People said, do you think they'll get even lower? My answer, even though I was a mortgage holder, was I hope not. Because I start to worry about the threats to my income if the economy is so bad that interest rates need to get that low.
That's right.
Well, returning to normal is a pleasant sort of thing to aim for.
And is it realistic though? Like, are we going to return to normal, Chris? Like, do you think that?
Well,
that's a general question.
How long do you want the podcast to be? That sounds like a chapter 2. But it seems a long way off, and I think for investors, what that means is that at the moment, this low inflation, low interest rate environment looks like it's going to be around for a while, and what that means for you navigating through it is as important as ever. But it certainly means term deposits aren't going to come roaring back to any sort of rate that anyone would be
too excited about.
We're in the 1 to 2% zone for a little while, I think, unfortunately.
Okay. No, that's really good, Chris. I think you've really helped me to sort of frame this a little bit better in my mind as well, because it's something that I've probably been quite guilty of, just assuming that, hey, inflation is just this little monkey over here. It's not going to bite me. But it could bite, or could just nibble away at me eventually, right? And I've got the bananas after all, right? So I appreciate that. Thanks again, Chris, for coming on the show. And we'll leave there. Cheers very much.
Cool.
Thank you.